Their market wrap up. And as usual, I have Roger Scott with me today. Roger, how are you?
I'm doing great. Thank you for having me here.
Of course. Roger, this week has been really characterized as a continuation of the retracement across almost all asset classes, really. And today is, sort of setting up as a irresolute day at this point. It's just kind of like hanging in there, going sideways. But tell me, how do you categorize this continued, essentially since the beginning of September, retracement across all of these asset classes? What is that telling us?
It's actually telling us that the market is doing precisely what we were expecting it to do. I mean, literally precisely. If you remember about a month and a half, 2 months ago, I was saying how typically during the election cycle, what we see is a market that does what the market typically does in the summer. It moves it all forward to the fall. So in other words, instead of having a calm market during the summer, we have a calm market during the fall. It's exactly what happened last election cycle as well. And it makes perfect sense. I mean, the level of unforeseeability on the table right now, James, is, I mean, you've got elections. You've got Trump straight up saying that he's going to protest if he doesn't win. And the fact that Justice Ginsburg died doesn't hurt. I mean, everything is setting up. Everything is setting up right now for the perfect tidal wave, in my opinion. But I think markets just don't know what to do with themselves right now. On one hand, we're waiting for this COVID-19. People don't know whether they should be staying at home. Leadership in this country hasn't been all that consistent. I don't want to say strong, but we have President Trump saying one thing. We have the head of the World Health saying another thing. This guy's telling us to wear masks. This guy's telling us, it's okay. There's a lot of confusion going on right now with everything. I mean, with everything. We don't know what's right and wrong right now. The country is in a state of confusion right now.
Yes.
And I think that's going to remain this way till about a week, maybe 2 weeks till the elections. And then I think we're going to the market's going to start really favoring who they're going to pick, and we're going to start seeing more of a trend. But I just don't see strong trends developing over the next month. It's too risky. It's too risky for institutional traders to take strong positions. Even retail investors don't know what to do. Mm-hmm. And also, if you look at the overall market, and I look at the market every which way possible, internally, externally, I take a measurement daily. Right now things are in an influx. You have 4 stocks today making 90-day breakouts. Usually you have about 100, 150. Four stocks. And one of them is a takeover stock that's just kind of sitting there waiting for. So that's not even moving. So it's like 3 stocks, and you've got like 30 stocks making 90-day lows. So the market is just it's. Then on top of that, you've got like 60%, over 60% of stocks are slightly below the 200-day moving average. So you've got a tech stocks that are still somewhat slightly bullish. You've got the overall market that's literally sitting on the 200-day moving average. The technically we're in twilight zone, as I like to call it, between the 50-day and the 200-day moving average, and we're all just sitting here going, there's no concrete direction. It's almost like we're at a turning point, but we don't know if we're going to go back to the stay-at-home environment, or if this is going to be it, and we're going to turn the corner. We're kind of just approaching that corner. And at the same time with the elections, we don't know if we're going to be going this way or this way. And we're right there. We're at that intersection, and we're getting really close. Another 3 weeks, another month, and that's it. We're there. So I think the market is and then in addition to that, we've had a major rally on big caps like Apple and Amazon. They're really overbought right now. Warren Buffett had, I think, 50% of his portfolio in Apple, and we're not going to know for another 3 weeks or a month how much of that he's been selling off, because Apple has been selling off almost daily. So there's a lot of things going on right now, a lot of things going on. And at the same time, it's kind of like there's a lot of things setting up right now. That's a better way to put it. There's a lot of things setting up, not happening, but setting up to happen. And I
Right.
think the market is kind of just saying, come on, which way? Show me a sign. Are we going left? Are we going right? Are we going left? Are we going right?
Yeah.
And there's no clues right now.
Right. Now, in terms of the coronavirus, I saw, I track a lot of headline news because those are often the first indicators that a major fundamental change is happening. And so I've started to see an increase in the headline insinuation that lockdown is coming back without a doubt. And we're starting to see that happen first in Europe, like the UK, France, and Germany are all talking about already rolling back all of the openings up, the stage 4, 5, etc. And in Canada, actually, the Ontario health practitioners issued a statement saying that Ontario needs to go back to stage 2 right now to avoid a catastrophe. So those headlines always precede a government announcement of, guess what? We're going back into a locked down state. Now, in the United States, the idea of closing the economy, of restricting movement, has become so politicized ahead of the election, and now with the demise of Ginsburg, and it's like, so the United States, it's like, well, the politicians on either side are ultimately very sensitive to this idea of lockdown. A Democrat in a battleground state cannot at this point suggest that they're going to support an economic lockdown. And at the same time, on the Republican side, they are, not willing to brook any discussion of a lockdown because that's an impingement on freedoms. And so, to me,
And it's a reflection, and it's a reflection on President Trump, at least to some degree.
Sure, right,
Yeah.
right.
Yeah.
And so, so really, it's gotten to the point where the whole world has had to turn away from the United States for leadership on this issue because, the direct interference with the CDC board is one thing, but the politicization across the country in the whole electoral sort of context is another thing that makes everybody say, well, never mind what they're doing, because the United States has unfortunately put itself in a position that they're not able to protect themselves. And so I look to the surrounding area, and what happens in Europe and then happens in Canada is ultimately what will happen in the United States, because there won't be a choice, especially after the election. It won't be so politicized. It'll be like, hey, now we've just got a pandemic and possibly, some argument over who the president is.
I'm in agreement with you. And just to add to what you're saying, to the confusion, you remember a few months back, everybody was talking November, coming out with a cure, a vaccine in November. I don't know if you've seen this or not, but all of a sudden in the last couple of weeks, everybody's now talking 2021. Nobody's talking November anymore. Even Johnson and Johnson. So the market kind of had this like time period that it was getting ready to do, because the market always perceives everything and prices everything in. And now all of a sudden that time period has been pushed, which creates more of what you're talking about.
Sure. So that's the point I was trying to get at. And I'm interested in hearing your thoughts on this, is like, when I see the market go into this condition where the VIX it's not saying everything's cool, and it's not saying it's time to panic, but it's definitely pointing to an absence of stability. And then you've got these indicators across the leading stocks where, this extremely small percentage of them are setting new highs and breaking 200-day moving average, while 90% of them are setting new lows. And all these asset prices are dropping. And, if the asset prices move around, if money travels from one class to another class, that's the same liquidity in the market at work. But when all the prices of all the asset classes, gold, oil, commodities, stocks, futures, and ETFs, when they all start to contract, to me, that says clearly that money, liquidity, is leaving the entire system. And so, in that state, it's like, you don't really want to look for the reversal. You want to look for a sign that the exodus of liquidity from the market is easing up, and that's when to get ready. So I think that all these indicators are showing us liquidity is going to the sideline and grabbing a bench, and going to get a hot dog and some French fries for now, but there's decreasing participation across all asset classes in the market. So my question for you is, like, does that mean we should be deleveraging, deliquefying our positions in the market too? Or should we be adopting more of a, just a hold pattern, wait and see? Or should we be deploying capital in some other asset class that's going to bring us some profitability in the near term?
Well, honestly, I was saying about 6 weeks ago to lower your exposure. If you recall, first I was talking about aggressive stocks, then I was talking about ETFs because there was more risk and volatility involved. And then I said it's a good time right now to put some of your assets in cash. I recommend people should be exposed by about 15-20% of what they typically invest in the market right now. I think right now, with the uncertainty we're seeing, and this is nothing new, James, that I'm saying. This is what I've been preaching this at least for 3 weeks now. Cash is king right now. Lower your exposure. Whatever you have, lower your exposure. And I just want to add, and I agree with everything you're saying today. And I just want to add a couple of things that were giving us clues, by the way. And this is really important. So number one, volatility. I agree with you 100% volatility. Volatility is telling us right now, it's a wait and see. Don't get too complacent. It is almost 3 times where it was a year ago. Anything over 20 is danger zone. We've been near 30. So the market is not warm and fuzzy right now. It's kind of sitting there and going, are we gonna, it's very much, as a matter of fact, technically right now, and fear are for the first time this year, or not the first time this year, but they're finally at 1. Because with the VIX level where it is and the S&P below the 50-day moving average, again in the twilight zone, that kind of makes sense. Because when the S&P is making new highs and VIX is at 30, kind of seems odd. But notice the VIX hasn't increased all that much with the S&P coming down, which kind of tells us everything is priced where it should be. And the fact that we don't have a lot of volatility right now and markets are sort of calm also confirms that nobody's really looking for price discovery right now, that people are kind of all in agreement on where they are. Also, put the call ratio with the market going down hasn't peaked out, which means there's not a huge amount of fear. Notice the VIX hasn't been spiking up. That's another factor. So everybody's kind of just cooling off. Large institutional investors, if I had to bet, they took about this shakeout we saw, not shakeout, but this downside we saw was hedge funds reducing their positions quite a bit. I think Warren Buffett took a lot of his Apple position off the table. Personally, we'll know for sure when the 13F filing end of the quarter comes. But this is just my personal belief. He had 50% exposure in Apple, which is unheard of. Apple had too much of a run up. I think he took some profits or lowering his exposure in tech. But what I wanted to tell you that I think was really telling, and I know you're not a huge technical guy, but I think this is really interesting. And I was pointing this out in the video that I did a few days back. On the 2nd of September, the S&P made an all-time high. Okay. And since that time, it's been going down. And a few days back, I think 3-4 days ago, it tried to rally again and it just couldn't do it. And if you look technically at the S&P, you could just draw a trend line going down right now. When the S&P tried to rally for that second day, don't quote me on the day, but I believe it was right around the 20th of this month, give or take, right around the 20th. I looked at my stocks making new highs, and guess what stocks didn't just peak out on the 2nd of September, but continued going higher and higher and higher, even as the S&P was going lower. Zoom, Peloton. Are you seeing a pattern here?
Exactly. The stay-at-homes. Yeah.
Not only did the stay-at-home stocks didn't follow the S&P, James, they completely shrugged off the S&P. And when the S&P tried to make a second high, couldn't even come close, they superseded that high and went higher. So if you were to look at Zoom, if you were to look at Peloton, there's like a dozen other names. It just escapes me right now. But the typical stay-at-home names that we've all come to. Oh, Roku. Roku was one of them. Stitch Fix, Pinterest. the same group of stocks that started really making headlines around March and April were the exact same stocks that were completely shrugging off this correction completely completely telling the S&P, nope, we're not going to play that game at all. And that's positive. That's positive, and I'll tell you why it's positive. I think if the stock market was ready to completely go down, I don't think you would see even an uptick in the stay-at-home stocks. The fact that we saw an uptick in about 15, 20 stay-at-home stocks tells us that the market will more than likely not continue going lower, but adopt the stay-at-home stock, and we will see a resurgence of what we saw in March and April and May. So I think that was a very positive sign. And that's telling me the market is going to start coming back. I think the market is going to start retargeting itself. And I think we're going to have a period of this, for most stocks, just kind of a choppy sideways trading action, not a lot of volatility, not a lot of trading range, not really breaking lows or highs, kind of wait and see approach. But at the same time, I think we're going to see a continued uptick in those stay-at-home stocks that I just mentioned. That will, to a large degree, confirm the thesis that you and I started this session with. And B, it'll also tell us that we're a little further away from the vaccine. And 3, it will also tell us that most investors have a stronger than average period of uncertainty behind them right now.
You bet. So does that improve the argument for anything other than the wait and see or the reduced exposure? Like I'm looking at gold seems to me to be now, and silver more so, seems to be at an extreme discount relative to its fundamental sort of basis of argument on the pro side. And so it strikes me that, it's like there's one thing that I think you can buy without getting hurt here. It's probably precious metals and precious metals related stocks, because they're all on at a discount. And this is consistent with, ratcheting up uncertainty and volatility, though we haven't really seen ratcheting volatility. But still, I mean, it strikes me that that's a place where you might want to place a small bet, because if things go, if we head back towards a March event, then who was the main benefactor of that was gold, because the central banks, stimulated and printed money, and that caused a rush to gold because there was a fear of the debasement of the currency. But so is there any other asset class that we might consider in that context?
Well, you mentioned precious metal, but I think copper. I think there hasn't been enough attention given to copper. It has a lot to do with industrial. Over the last 30 days, industrial basic materials have been king. And I think regardless of the direction we're going, I think the market will have to get back to value. And when the market gets back to value and away from all this tech pie in the sky, and which ultimately always happens, I think that we're going to see upside in copper. And I think there's going to be a resilience in copper, because there is some minor correlation between copper and precious metals, believe it or not. They tend to go, it obviously tends to follow, not lead, but when gold rallies, copper does too. And there's another argument that you didn't mention, it's the US dollar. I think also the fact that the US dollar is so subdued is also going to cause a lot of investors to look outside of US, especially if the US dollar stays this way, and I think it will for quite some time. And I think as a result of that, gold will also rally. Also, we've seen an extreme correlation between the stock market and gold, which is not unheard of. It's happened many times before, as a matter of fact. And so a lot of people are kind of surprised that's happening. It's really not that surprising. So I think that the fact that stocks are seeing that wait and see pattern, and stay-at-home stocks are still stocks. So this kind of let me kind of combine the gold argument I'm making right now with what I said previous, with the fact that the stay-at-home stocks took out the high that the S&P made and shrugged off the high. I think that those are still stocks. That's a rotation, but those are still stocks, and there's a lot of value in those stay-at-home stocks. So my point is, if gold continues to follow the correlation with the stock market, and I don't see any reason for it not to, I think that we will see another leg up in stocks as well as gold. I think we may see that kind of wait and see period with gold, like we are seeing with stocks, persist for another 3 weeks, in my opinion. I think things are going to start moving again a few weeks prior to the election. And I talked, by the way, a few days ago, I talked to Tom Busby about this. He's also thinking the same thing. And a lot of other professional traders are seeing that too. Typically, this is not uncommon. The fact that gold is down, the fact that stocks are down, not atypical at all. I think with gold, the impact of gold will be more pronounced as we get a better feel for the US dollar and the bond market. I think those two are the biggest factor when it comes to gold, but I'm not seeing anything other than what you're seeing with gold right now, than a good value and potentially a good price to get in for the foreseeable future.
Right. Okay, Roger. Well, that's great. Let's leave it there for now. That's fantastic commentary as usual. I look forward to speaking to you next week. Have a fantastic weekend.
You too, James. It was a great talk, and have a great weekend. And I'll talk to you soon. And thanks for having me again.